At our strategy, we run a 5-phase cycle framework. We are not predicting headlines. We track signals, plumbing, and sequencing pressure, and we care more about confirmation than conviction. What if the most important global signal is not ships or headlines, but who is quietly stepping away from funding the system? Not a crash call, a pressure point that can shift rate regimes. Today, we are reviewing the video linked below. The creator argues that sovereign debt flows reveal intent. We recommend watching the original for full context. Our job is to translate claims into process. The video argues China is reducing United States Treasury exposure. It frames this as a sanctions risk decision. It claims allies absorb supply to stabilize markets, and that proceeds rotate into hard assets. In our framework, this is a rates and liquidity story. It also touches dollar funding and geopolitics. The narrative matters less than the mechanism. Plumbing always comes first. Sovereign flows are slow and structural. They matter as drift, not as headlines. Price impact depends on the marginal buyer. That is where auctions matter. If buyers shift from economic to political, markets can look stable until stress hits. Political buyers reverse under domestic pressure. That is where fragility appears. Heavy supply plus weaker demand raises compensation. That shows up as higher long-end yields. Even if policy rates ease, long rates can stay under pressure. Markets can ignore structural pressure when growth is fine, or when domestic balance sheets step in, or when volatility stays suppressed. But auctions eventually force the issue. We do not debate motives first. We watch auction tails and dealer absorption. We watch funding conditions and the dollar. Those are confirmation signals. The video argues allies absorb supply. We call that support capacity. Support capacity exists until currencies and voters push back. Constraints matter more than intent. Quick disclaimer, this is not financial advice. This is educational commentary on macro signals and risk management. Always do your own research. When an ally faces domestic stress, liquidity gets pulled home. That can force selling elsewhere. Foreign exchange stress becomes the warning. This does not mean immediate collapse. It raises Phase 2 pressure risk. If funding and auctions deteriorate, Phase 3 probability rises. First, tighten duration discipline. Second, respect auction signals. Third, keep optionality elevated. Avoid blind mean reversion. We do not go all in. We stage exposure in tranches. We separate base case from tails. Discipline does not change. The video suggests rotation into physical assets. That is plausible as a sanctions hedge, but we treat it as conditional. Leadership and confirmation matter. Track Treasury auction quality. Track dollar funding stress. Track foreign exchange constraints. And track risk appetite breadth. If auctions weaken and long yields stay elevated, Phase 2 pressure increases. If funding stress follows, Phase 3 risk accelerates. If auctions stabilize and yields roll lower, pressure can ease without crisis. If flows prove custodial rather than directional, the signal weakens. Debt flows are not destiny, but they shape who sets the price. That can redefine the rate regime. Sequence always matters. We do not need to be early, we just cannot afford to be late.